Bitcoin didn't just rise, it erupted. In a moment that felt like financial history unfolding in real time, Bitcoin surged past $120,000 and just kept going. Traders watched in disbelief as the price rocketed to an astonishing $123,000. Screens turned green, portfolios exploded, crypto Twitter lit up like a digital firestorm. But this wasn't just another breakout, this was a turning point. A signal to the world that Bitcoin was no longer just a volatile asset for speculators, it was becoming a central pillar in the future of money. But just as the market soared, it snapped back. Profit-taking kicked in, the charts reversed, and the question echoed across every Discord and trading desk, was that it? This wasn't just a story about price action, this was about momentum, regulation, politics, and market psychology colliding all at once. This was about Bitcoin growing up. To understand what really happened and what comes next, we have to rewind to the spark that lit the fuse. At the heart of Bitcoin's $123,000 breakout wasn't just hype, it was clarity. For the first time, Washington, D.C. wasn't just talking about crypto, it was moving on it. Crypto Week had begun, and Congress was lining up to pass a wave of pro-crypto legislation. Bills like the Genius Act and the Clarity Act were aimed at finally defining what stablecoins are, how crypto companies can register, and where the lines between securities and commodities should be drawn. These weren't empty promises. These were votes, laws, structure. And for institutional investors sitting on the sidelines, this was the moment they had been waiting for. The fog of uncertainty was starting to clear. Combine that with continued inflation fears, a weakening dollar overseas, and the increasing adoption of Bitcoin ETFs by legacy finance, and you've got the perfect storm. This wasn't retail FOMO like in 2021, this was a deep, institutional wave, quiet, powerful, and strategic. Wallets started accumulating days before the breakout, on-chain activity spiked. And behind the scenes, firms like BlackRock and Fidelity were reporting record ETF inflows. Even banks like Standard Chartered announced spot crypto trading for institutional clients. For a brief moment, the stars aligned. Bitcoin didn't just surge, it claimed territory. It felt like a coronation, a new standard being set right in front of our eyes. And then, just as suddenly, came the pullback. Traders know this story well. It's the rhythm of the market. Nothing goes up forever, and when something climbs too fast, gravity pulls it back. Bitcoin's RSI had reached extreme overbought territory. Open interest in futures was at a local peak. Whales, those massive wallets that can move billions, started distributing across exchanges. Quietly, cleanly, without drama. This wasn't panic, this was maturity. It wasn't a crash, it was an exhale. Analysts at Deutsche Bank even noted that the correction wasn't a sign of weakness, it was a sign of growth. This market, once driven entirely by emotion, was now behaving more like traditional finance. Strategic, predictable, disciplined. And that's not just evolution, that's revolution. Meanwhile, the real action was happening in the halls of Congress. Crypto Week rolled forward with momentum. The Genius Act brought structure to stablecoin issuance. The Clarity Act promised to end the endless SEC versus crypto guessing game. And the anti-CBDC bill, backed by privacy advocates, pushed back against surveillance-style digital currency proposals. This wasn't just a legislative sideshow. This was the beginning of a new era of crypto politics. CryptoPacs had spent over $100 million in the last election cycle alone. Lawmakers were listening, and the message was loud. Innovation is back on the table and the United States doesn't want to fall behind. With this regulatory tailwind, Bitcoin's rise made perfect sense. The market was reading between the lines. It saw safety, it saw opportunity, it saw legitimacy. And yet, as always, the question returned. Who really won the week? Was it the short-term traders who got in early and locked in profits before the pullback? Or was it the long-term holders, the ones who didn't flinch, didn't sell, and saw the correction as noise? The truth is, both sides had their moment. Traders who had discipline and timing walked away with gains. Holders saw their conviction validated, not erased. But the smartest players were doing both, holding core positions while actively trading with a small strategic slice. It's a hybrid strategy, a dual mindset, one part belief, one part execution. That's not just a trend, it's the new meta. And while all of this played out, the institutions were executing their playbook flawlessly. Standard Chartered opened direct trading, ETF providers ramped up marketing, state-level policies started forming. In fact, Texas made headlines by passing SB 21, an official order to create a strategic Bitcoin reserve. That's a state government, not a startup, putting digital assets on its books. This is what adoption really looks like. It's quiet, legal, boring even, and it's, incredibly powerful. So what does this pullback mean? Well, it means we're entering a new phase, one where volatility still exists, but it no longer feels like chaos, one where corrections are no longer collapses, and one where institutions, governments, and sovereign entities are playing the same game you are. That's the reality of Bitcoin at $123,000. But let's not ignore what the altcoin market taught us during this run. As Bitcoin dominance rose, many altcoins bled. Ethereum held stronger than most, thanks to its role in stablecoin infrastructure and DeFi expansion. But speculative tokens, meme coins, and low-volume projects struggled. Because capital moves to safety during breakouts. And in crypto, Bitcoin is the safety net. Bitcoin dominance is more than a chart, it's a signal. It tells you when to rotate, when to risk, and when to wait. Altcoins aren't dead, but in a maturing market, fundamentals are everything. If it's not building, scaling, or solving, it's bleeding. So where does that leave us? It leaves us with a choice. So, do you chase the next candle, or do you actually prepare a strategy? The next breakout is coming, and whether it's $150,000 or $200,000, it really won't be a surprise. It'll be the result of everything building quietly in the background: regulation, infrastructure, adoption. Now is the time to prepare. Go ahead and write your plan, set your targets, define your exits, and of course, know your risk. Because the next time Bitcoin surges, and it will, you want to be on the right side of history. You want to be ready before the wave hits, not scrambling after it. Bitcoin didn't just hit $123,000, it sent a message to the markets, to the banks, to the regulators, and to all of us watching from the sidelines. The message was clear: I'm not going away, I'm evolving, and the world is finally starting to understand that.